Hey, welcome everyone. Tom here from Park Avenue Trading, your chief dealer, keeping you sane in these insane markets and also giving you professional trading tips on how to build a day trading system that suits you. All right, let's get on to our lesson. Today is Sunday, September 15th at 10:37 in the morning. So in the last video, we talked about how you could basically use a different type of range projection. Also, previous videos, we talked about how you got to go to the weeklies, you got to go to the dailies, you got to go back a certain number of days that you keep consistent, because why would I want a red line going through my face? Hang on, I need a cigar for this. 1 second. Okay, I'm back. I hope you don't mind the smoke, but definitely need a cigar. Okay, so it is Sunday, as I said in the beginning of the video. So what we're going to do is we're going to project our range for tomorrow. Okay, now remember, you're going to have your pivot points and stuff from your 10 days before, but we're going to start with projecting the range for tomorrow. Now you could use the simple formula that I gave you in one of my previous videos, how to project the range for the day, simple formula, or you could use the formula that I gave you in the last video. Now, I got an email from someone today by the name, one of the people that watched the video, and he was, he said, "Hey Tom, you said that when you have a close, that is greater than, you're taking 30 pips off." The filter is really, you don't have to use the filter. The filter was used basically for a standard deviation to tighten up the range. Basically, what the filter is saying, if you're subtracting 30 off or adding 32, is you're trying to compensate for what's known as skid. Okay, so the easiest way to describe skid is this. A marketplace is like a speeding car. Okay, and let's say you're doing 100 miles an hour down the road, and then you hit the brakes. You're not stopping immediately. You're skidding. And that's what marketplaces do. They skid. So the points added and subtracted, the 30 points or the 8 points when the closes are equal, are just for skid. Now, how equal, when they say the close is equal, it's equal. The market opened at 184.83. It closed at 184.83. So if it's even slightly a tick higher, you would use, it's not going to change much. That's the whole thing. I mean, it doesn't change much. This is not, an exact science. These are concepts that you need to learn so that you can judge market momentum. This is the whole idea of this webinar series, is trying to teach you to judge price action. Many guys out there talk about price action, but what the fuck does price action mean? Really? I mean, okay, you're telling me price action, but what does it mean? I'm trying to break down for you, like, all I trade is price action. I don't care about anything else. I care about no news. I don't care about anything. I already have my points that I'm interested in during the day to give me an idea of what the marketplace wants to do. And then I can make educated guesses on whether or not a marketplace is going to continue or it's not going to continue, based off of those price projections. And then, other things, for example, let me show you a difficult day that we had on Friday, or a difficult day I had on Friday. And I'll even show you Thursday where I really had a difficult day. And just so you can understand that, I go through the same shit you go through. So hang on 1 second. Okay, on Friday, all right, I called a trade. I went short dollar yen at 140.85 with a stop loss at 141. That's a very tight stop loss for me. Okay, and the reason why is because I had no idea. I was in between points, and I was trying to what's known as leg into a cross. I was trying to leg into sterling yen. And if you don't know how to leg into a cross, maybe I should do a video on that, but it's very simple technique. But it's definitely, something that only a professional trader is going to know. most people don't even know how to calculate sterling yen, So anyway, I'm going off on a tangent. But I was short dollar yen at 140.85, stop loss 141. It wasn't going. And I basically was saying, wait a second, this is not breaking. It's not going. It's not getting me into a good position. I reversed at 140.79 to long. I turned the trade around long. I put my stop loss at 69. I told the group I'm watching sterling yen at this point. I squared at 140.95. This is not my style of trading. I'm not looking for 10 pips or 15 pips or 20 pips. It's not my style. But I was trying, at this point, I was actually battling the marketplace. I'm trying to figure out price action. I couldn't figure it out at that point, right? So I went short sterling yen at 184.90, stop loss 185.05. I took a third off at 184.75. Again, why? Why did I take it? Why did I take a third off? I was trying to get away from the fire. I was trying to get my position a little bit more away from the danger. Okay. There are two thoughts on that. It's like, don't do it, because if you're right, you're not going to make as much money. And there's my thought that I want time to think. And I want the marketplace to develop a little bit. A lot of times I don't do it. A lot of times when I'm, when I add to positions when I'm in the money, and then we're going to talk about that, exactly when you should be adding to positions. And that's just based off of volatility, or you could use it off of patterns. I put my stop loss at the average. It went down. Actually, wait, I did. Yeah, I took short sterling yen, 84.90, 1/3 off at 74, stop loss the average. And then I squared it at the entry. Then I went short again sterling yen at 184.95, stop loss 185.10. 1/3 off at 184.86, stop loss the average. 1/3 off at 184.62. Stop loss entry, and then the trade got stopped out at entry. So these are the type of things that I'm posting in the trading, on the trading floor itself. Now I'm going to show you just Thursday, which was, a bad day for me. All right. I went short euro yen at 157.02, stop loss 157.2, 157.63. Now that's a normal kind of stop for me, about 50, 60 pips. I took a third off at 156.85, and I moved my stop loss immediately to my average. I took a third off at 156.65. I thought it was stalling. Stop loss entry. It did. It got stopped out. On to the next trade. I went long US dollar yen at 142.43, stop loss 142.23. I said the trade sucks. I got out at 142.37 because it wasn't going, and I just got out, Here was the killer. I went short sterling yen at 186.12, stop loss at 186.62. I realized that I needed to move my stop up by 5 ticks. I wasn't moving my stop. I made an error in my calculation. I got stopped out at 4 pips off the bloody high before this thing collapsed down. I got stopped, and then I ended up. I did my own personal trades afterwards, but I didn't post those because I got punched in the face, and I basically said, okay, let me regroup. And so this is like the kind of stuff that you see that I'm doing in the trading room. And I also basically do analysis for them, and we chill out over here and we talk, and I show a picture of my dog. He's my trading partner. He's a Newfoundland puppy. He's awesome. I love that dog. Anyway, let me get back to actually what we're doing today. Okay, so we're going to basically calculate the range. I'm going to use the little bit more complicated method of calculating it. like I said, you could use the simple method, you could use the complicated method. So let me go do that, come back to this. Okay, so we have a close on Friday that was less than the open. So I did the calculation. All right, I did not use the filter. Okay, it doesn't change much. It changes it by like 3 or 4 or 5 pips. So for me, I just put it in. When I put it in my Excel calculator, I just use the high today plus the low today plus the close today plus the low today divided by 2 gives me X, and then, you know, blah, blah, blah. But anyway, okay, so this is basically our projected range for the day. Now, how we should look at this, you know, these values like just provide like a benchmark for like what the ensuing price activity a day could be. So, you know, if the marketplace somehow opened up way below, now this is basically going to the 3 steps book. All right, so hang on one second. Let me get the 3 steps book. I had to get the book because I didn't measure, you know, I don't memorize what pages this stuff's on. But mechanics of a 3 steps checklist for a downside break, and this works for this stuff as well. If somehow this marketplace just opened below this level that we calculated, there's a major shift in supply and demand. So the marketplace basically is now saying much lower. Now, this is just hypothetical, right? If it opens below that price, there's a shift in supply and demand. There's more supply out of nowhere, and something happened, you know? So the marketplace is just moving down. So what do you do with something like that? Well, you say that this is now the projected high, and you have no projected low. Now, contrary to that, if the marketplace opens above this projected high, then there's a shift in the marketplace. So, you know, if you look at the checklist, you know, it says the opening price opens up below a trend line or a pivot point or, you know, a price projection. It's giving you an indication of price action, right? If you open up above this level, okay, there's a shift. So basically what you do is you say, now this is my projected low, and you know, you don't know a projected high, but you can kind of, you could basically do like a volume, like a volatility analysis, and come up with a basic area of like where resistance should be. And that's beyond the scope of this. But, you know, a little selfless promotion here. It's in Tau of Price. It's there. It basically shows you, you know, projections, price projections. And, you know, again, what you're doing with those price projections is you just keep taking them with a grain of salt. So here we go. We set up basically our market fence for today. So we have that. We'd go down to 1 hour. Now, what I'm going to finish this video on is something that I get asked a lot about, like, well, what's the trend for the day? Aside from having this, you know, these levels, okay? What now? Also, you can use the simple method. I think I said that in the beginning. The simple method is fine too. It's whatever one you feel is you're more comfortable with, whatever one you think, whatever one you like more. You know, that's the way it goes. It's dealer's choice, you know. Like I said in the previous video, there's no like real magic. This is basically trying to teach you price action. So what is a good way to determine like what the trend is for the day? And this is a very simple way to do it. There's something called 3-bar harmony, 4-bar harmony, 5-bar harmony, 6-bar harmony, whatever harmony you want, okay? But we're going to just use, say, 3-bar harmony, and then you could test the other ones out once you learn the system. So 3-bar harmony was developed, I mean, it's been around forever. But we call it 3-bar harmony because, you know, what's the marketplace singing? How's it singing today? What's the harmony of the market? It was really, you know, hang on, let's do that. Okay, let's go over 3-bar harmony, and this will help you determine the trend. Hang on one second. I got to light my cigar again. Okay, so one more thing before I move on. And, you know, I'm sorry, I'm scatterbrained, but I do this off the cuff. But so these values here as a day trader, what do they mean for us? Well, they actually mean that if the market opens up inside this, you know, projected range, then we could expect resistance, you know, above this of the projected highs range, and we could expect support, you know, kind of by the low of the range. Now that's different. Now 3-bar harmony is going to say no to that, and I'm going to explain it to you right now. So what 3-bar harmony is saying right now is if that low goes, the marketplace is moving lower. Now, it doesn't mean it's going to move immediately lower from that point. You need to know, like, okay, if the marketplace breaks, then I should be looking for levels to sell it on rallies. And then you need to go back to your daily breakdown for your hourly chart, your 4-hour chart, your 30-minute charts, whatever you use. You're going to be looking for peaks to look to sell at. But anyway, so what is 3-bar harmony? 3-bar harmony is simply you look at the last 3 bars, 1, 2, 3, and I'm going to move these now, and you're going to say that the marketplace is turning bullish if we get above 186.70. It is turning bearish if we get below 183.70. It is the lowest low in the last 3 bars. So this tomorrow's opening, Monday is opening, so the last 3 bars, I'm just using these last 3 bars as a gauge to tell me whether or not what is the marketplace doing. Now let's go back in time, okay? And in the next video, I'm going to go over a great thing for trend within the smaller time frame. But I don't want to take too much time. Nobody seems to really want to watch these videos that are 25 minutes long or 30 minutes long. All right, so let's go to, let's say, for instance, this is the day that closes, right? So we're up at a high, and everybody, you know, that has no fucking idea what they're doing. Oh my God, this thing's going to take off again. It's going back to 208, you know. You get all euphoric, okay? But here's the key. If you go back, this market's opening. We don't know what's going to happen today. You go 1, 2, 3. That is the warning. That is the break. If this bar breaks, the market's turning bearish. And look what it did. I mean, it was just wonderful. If it was going to be bullish, it would have taken that top out. So this marketplace closes. So you go, this one's just opening. You go 1, 2, 3. Okay, what's the highest high? It's this one. What's the lowest low? It's actually that one. I mean, make it perfect. And that basically tells you the trend. Now, does it work all the time? No. All right. But, however, when you do 3-bar harmony, now you could also do 4-bar harmony. You can go back 4 bars. You could go 5-bar harmony. You could go back 6-bar harmony. You could do how many bars you want to go back, as long as you stick to them. You're not optimizing. You're not going, oh, well, 3-bar harmony would have worked, but 4-bar harmony didn't work, so I'm going to say I use 3-bar harmony. No, you got to stick with what you got. So, just to recap, in this video, we went over calculation of the projected range using a little bit more complex formula. I did not use the filters, okay? And I also went over with you basically how to predict what the marketplace is whispering in your ear using 3-bar harmony, right? I don't know if we have, I got to do the market analysis video today also for Monday. I'm going to leave it at that because you guys, please, if you like what you see, smash the like button, subscribe, get on over to parkavenuetrading.com, get yourself 3 Steps ebook. It will really help you. Also, leave some comments for me, please. Tell me what you think. I really want to engage with you guys. And remember, enjoy the party, dance near the door. Cheers.